This is the Walker Report. Today we are joined with Rafi Tahmazian from Canoe and heads up Canoe's energy and you were the chief portfolio manager for 3 of Canoe's funds. You come to us with 31 years of experience in the investment industry as well as the oil and gas space in Canada, and I'm very pleased to have you join us. Is there any part of your biography that I have missed, Rafi, that you would like me to touch on?
I think the only thing I would always, we tend to add more to it now, is we want to give people the comfort around, what we are as a portfolio manager. We're a little untraditional in that sense. We're not investment professionals.
Okay.
Our group, in particular, Energy, was developed around the founders of the firm, which are, myself and Bruce, who came from the oil patch. And my partner Dave was an energy analyst prior to this at an energy boutique, and our trader that works solely with us came from Bissett Templeton in Calgary, trading the energy space 7 years ago. So we're energy professionals making energy decisions. I always joke about it. I'm literally born 4 blocks from here, and I live 4 blocks from that. My father was in the oil patch from the 60s and the 70s. Through the exploration phase. I was in the oil patch in the late 80s, early 90s, as the exploitation of the basins played out. And really, energy banking I went into then for 15 years. And really, I entered the energy investment period right as the basin has moved into this manufacturing role, as the basin matured into this big cash cow that it is now. That's kind of as my career is coming to its finale. It's almost in conjunction with the maturity of the basin, and we followed that the whole way. So, I think you get a fairly robust understanding of the local energy market. But I'm an economist by background and education, and so I came about my energy knowledge through economics. I'm a top-down investor, so we have a more holistic image of what the markets are doing, as opposed to talking about equities all the time. So this discussion, as you know, will be more about kind of top-down approach as opposed to bottom-up. And that goes towards our nature.
Well, that is a much better introduction than I gave you. So I'm glad you've taken the time to do it. Let's start with that very high level, then top down kind of thing. I think when I speak to my own clients, the people who end up watching these videos, I think there's a lot of misunderstandings, or at least there's not a really comprehensive, good working understanding of like, what is the global picture for oil? Like, they don't, we talk about a global price for oil, but we don't really have a global price for oil. We talk about whatever the price of a barrel of oil is, but there's lots of prices for barrel of oil. Not all of this stuff is equal. So can I start you off there? What is the global picture for oil today when you're starting at your very high level? What are you?
Yeah. Well, I mean, I guess I would almost say there's a definition of energy, then there's a definition of the energy within that. And energy includes gas, oil, coal, alternative energy strategies that are sometimes called renewable, but we call them alternative. And then there's nuclear. Those make up, there's biomass and hydro as well, but biomass and hydro would fall under those alternatives. So we look at all of those power sources as an aggregate, and they get categorized into how we break energy into these 9 subsectors. So oil is one of them, gas is one, alternative energy is one, refining is one, LNG markets are one. These are massive, massive subsectors within energy, multi-billion-dollar subsectors. And some of them are in Canada, some of them you have to go outside of Canada to get them. And we look at all of those things. And I think what we want to make sure investors understand when they talk to us and invest with us is we're taking the issue or the decision out of their hands in terms of what weighting they should have in alternative energy versus conventional energy. Because that's an investment decision. It shouldn't be a decision that you're making with your heartstrings. It should be with your purse strings. And it's a very dangerous thing to do if you do it with how you feel about things. So our top-down approach is trying to gauge where the pendulum is swinging on each of these commodities and how you should be weighted in them at what times. You focused on oil right away because that is where we should be focused today. Focus on oil and gas in particular. We are going through a very aggressive correction period in the alternative space. It got massively funded and it got way overpriced.
So, sorry, and alternatives here are solar, wind. Is that
Yeah, solar, wind, and technologies around hydrogen, and all of these experiments that are coming along with what they call the energy transition. There is no transition yet because you have to transition into something, and we are like absolutely, completely overwhelmed and addicted to these conventional oil forms still. And really, we see kind of coal being replaced over time by gas. And we see coal being replaced along with even some oil by nuclear. Those are going to be the first areas over the next decade that are going to have any impact on shifting our fossil fuel and emissions issues. Otherwise, we are going to spend a lot of money trying to eliminate the emissions of hydrocarbons. We're going to learn to live with hydrocarbons because we can't get off them. The biggest issue our clients need to understand is the kind of discussion that they hear in the media and through politicians is the world needs to get off of hydrocarbons and we need to be into these alternatives. Well, that's all nice in a sentence, but if you don't mention in between that it will be an enormously costly thing for you, then you're not getting the full story.
The best example of this is like Germany right now, right? They've spent considerable sums of money to broaden out their solar and their wind capacity to the point where they were shutting down nuclear plants. And I think this year they were on schedule to use the most coal they've used in a decade.
Yeah,
because they're not getting enough after Russia had pulled back some of its transfers of oil. This is where they're at. They don't actually have enough energy to meet industrial needs.
Yeah, so they spent oil prices were trading in the $80 to $120 range this summer. They spent $400 a barrel equivalent having to fill gas storage. So their gas storage is getting full, and that's good. But the bad news is they went bankrupt doing it.
Okay, so I'm going to pause you there, if
We're
only
going to- yeah.
because this is where I think people get very confused. This stuff is right. You are rifling through so many questions that I think people would have. So I want to pull it back a bit. Let's start with that energy situation to begin with. In January, you, amongst other experts in this field, had a view of the energy market that was extremely bullish for the oil space in particular. What was that view? Even before Russia's launch into Ukraine sent a number of things happening. What was the view? What was the 10,000-foot view that you had on energy?
That was the investment thesis. The investment thesis was built on global supply was in peril because of a 20-year decline in spending in oil fields. And we need massive capital just to maintain production globally. And all the super majors started getting attacked in 2015. We saw their capital spending drop by 70%. This was a movement to try to derail the oil production. Well, they did it. So it worked, but the bad news is we need it because the replacement, this alternative, never showed up. So the supply is not coming back. And I could go into that and in quite a bit of detail with you, but I would tell you that that's not a prediction, that's a fact. So we have all the data that would tell you you'll see supply coming in slow motion because the only way supply is coming back is a massive capital program. And the only capital programs globally that have occurred at all since 2008 is in North America. Since 2008, North American oil production is up 82%. And the rest of the world's production is down 6%. And they are 72% of the production. So the global production has been completely ignored. North American production maxed itself out ran on a treadmill very fast and collapsed as it destroyed returns. Now it's just this manufacturing business that is humming. It's not growing. So supply is completely stymied. Demand was the other part of the thesis. It's out of control, growing. And it's growing because people have to think of it not as the world demand, separated into the developed world and the undeveloped world, or the OECD and the non-OECD. And that's the deglobalization that's occurring now. COVID kind of tipped that over, but COP26 was the killer, where the developing world really realized that the developed world was on another path with, they watched how the developed world accelerated its vaccinations. And by the time COP26 came along, we were all vaccinated twice and fighting for our third shots. India was 5% vaccinated, and they're going, what do you mean our carbon footprint? Is that really what you care about? So by then, there was a complete disassociation, and we've seen that happen and get aggressive now. So you've got the developed world that only produces 30 million barrels a day, and we consume 45. And so the developing world has all of the energy, the oil we need, and they will use it as a weapon of war on us. And that was the next thing in the thesis, the security risk. And lo and behold, the Ukraine war developed, and that would be Putin using oil as a weapon of war. And he's selling that oil that he has cheaper to the developing world because they have so much of it, and we're getting it more expensive. So while our economies are starting to suffer, the cost of running the economy is more expensive because they're charging us more, and they're injecting cheaper oil into their system to build out their healthcare and their manufacturing and their transportation and infrastructure that they desperately need, and buildings to get themselves to a place where they can have a fighting chance here. But our solutions for them were these variable, alternative, expensive power systems that weren't working. So demand, supply were thesis, and energy security risk, and geopolitical risk too. All of these things were building, and the sector in the meantime was financially cleaning up very fast. So by January of this year, when you say we were very bullish, we were looking at an industry that was, historically runs around 1.5 times debt to cash flow. By the middle of this year, they were 0.3 times debt to cash flow, and they will be debt free by the middle of next year. The entire industry, with the exception of the oil sands, who have, this larger amounts of debt, but they are already manufacturers. And the amount of cash these companies are developing is so enormous that they don't even have time this year to allocate it for us. Canadian Natural Resources, the largest producer in the country, still is not accounted for almost $6 billion of free cash they're generating this year. So this is all coming back to you now because they have become manufacturers, and they've structured themselves into distribution models. And that's the best thing that the client needs to understand the most, is this industry is not the traditional industry it was, growing, spending multiples of cash flow, growing debt, growing volumes, growing decline rates to fall off a cliff. These businesses have pulled back all of their spending. They're only spending what they need to stay flat, which amounts to about 60 or 70% of their cash. The remainder of it, they've structured themselves into distributors or manufacturers, driving the cost of the widget down. And when you buy back all the stock and you get all those dividends out, it equates to about a 12 to 13% yield right now. The S&P average is 2%, 1.8.
Okay. I got to slow you down again, because you know what? You're so enthusiastic and I love it. But I think, again, we're tripping over ourselves because there's stuff. Let's start with, let me sum up what I think I've heard, and so that people who are going to pay attention and follow along. So the world is splitting in two. along the delineation of developed countries or OECD countries and non-OECD countries. And the non-OECD countries are responding to what seems like a misalignment of interest from us about what we think we want from them. And it seems to be completely bypassing their own development goals. So they're going to be buying up whoever has the cheapest energy on hand, which will allow them the freedom to do the development that they want. And right now, Russia, who is persona non grata in OECD land, is, that's where they're selling their oil to. And they've got whatever they've done, cost controls and currency things. India, China, they'll play along with that if it means that they get what they need. Meanwhile, we have since 2014, which is when we saw the price of oil really collapse towards the end of 2014, on the back of, I think it was a fight between OPEC and American fracking companies for the most part, who were mass producing.
Right. Yeah.
We haven't seen any real capital spent to boost production. We've just hunkered down. I used to live in Alberta, and I'd go out to Fort McMurray, and the guys would say, look, this is not a growth period for us. So we have what we need to do. And we've got our barrel of the price of getting the oil out of the ground still higher than maybe some other competitive places, but we know what we need to do if we're just maintaining. And they hunkered down that same way. They're not spending money that they don't have to spend.
Yeah, but that's not going to change now. That's the other key here.
Okay.
To transition back into spending won't happen.
Why wouldn't that not happen?
Well, the producers are more profitable like this than they've ever been in the 40 years in the business.
Okay.
So why would you change your business model to be a risk-taking capital program where you don't have the equipment available without massive cost overruns? Your business is structured as a distributor now, not a grower. It would take hiring a whole staff again of explorationists, developing a capital program for exploiting an exploration, going out and procuring all the assets, which would be impossible for all these companies to do because the equipment's not there anymore. It's all been mothballed. Even if you did have the equipment, or you were able to, the service companies were miraculously able to build it, which they can't. Who would man it? There's nobody to run them anymore. The productivity appetite for people to work is negligible in the developed world now. So all of these things are working against it happening. And then on top of that, the investment community still fights when you try to grow. But let's take that all back a step. These producers are becoming extremely wealthy human beings today doing this. And to the old sailing adage, you don't leave wind to find wind. And it's blowing hard here. I'm 31 years in the business. This is the most productive it's ever been in my life by a long shot.
Wow. Can you explain what a super major is? You touched on the super majors as saying that they've gotten out of a lot of this. They're not spending money. Who are they?
That would be like BP, Shell, Total. Even Suncor got stuck in that. And the old Williams group before Little that was running it got kind of taken out by this movement that tried to disrupt that group's ability to go out and get these massive programs done. They were the companies that would go out and their production would be kind of representing 70 million barrels of the production in the world, 60 to 70 million of it. And their decline rate is about 6%. So they're replacing the equivalent of Canada every year in production, just in decline rates alone. So to grow it, they had these long lead time programs where they'd be maybe doing an offshore Angola thing. That'd be an 8-year project of massive capital, drill, and then building the platforms for production, then tying them in, creating the marketing. 8 years later, you start getting, 4, 5, 600,000 more barrels into the system. That stuff, the anti-energy movement got infiltrated these businesses and stopped it. So now these businesses are just running on idle on that front, and they're pursuing other alternatives. That elevated their risk because they're investing in these alternatives, which are experiments, instead of investing in longer term production projects that is their background. So they inherently left the wind to go find wind, and it's not blowing over there. So that group is very risky to invest in. They're very stagnant, and they are also focusing on an area that we think is not an area you should be pursuing right now. There'll be a time to pursue alternative energy again when it financially makes sense. And we have 14% of our assets in that group. All, bulk battery storage business, a water recycling business, and a biodiesel business that are all businesses we helped build, and we're doing real things for the next movement. But those things are idling along. Really, all of your wealth should be invested from a power perspective in the area that's going to affect your costs the most. And that is the oil and gas industry right now.
Okay, so you've outlined this very negative view of global supply and who we need and how much we need and where we're getting it from. And the economic view is grim. I mean, this is not this is inflationary to everyone. It's not, obviously, I don't think anyone's missed the news about, even Russia's involvement in Ukraine has highlighted how vulnerable we are in terms of energy. Germany in particular, very exposed to Russian oil. The question I have that goes on from that, though, is that we've watched the price of oil come down this year. It got to a peak of, I think, in the early summer of around $115 a barrel. Well, maybe that wasn't the peak, but it was up at $150. And then through June, it came right down to, I think, the low 80s, maybe even a bit below. We're around $85 a day. This view you've had since January, and you're not alone in it. Why is it that we're not seeing greater uptake in the price of oil? Why are we not seeing West Texas?
Yeah, it was two very specific reasons. One, the first one that hit about April was China did a slowdown. They put the brakes on, and for whatever reason you could call it a COVID zero initiative, or just slow things down because they needed to replenish inventories. They took about 2.3 to 2.6 million barrels a day out of the market of usage. Then on top of that, the U.S. administration, Biden's administration, saw that he was losing ground to the Republicans because of directly proportionate to the gas price going up at the pumps. So he took the security resource that they have, the SPR that they have, this oil that they sits in these different storage areas across the country.
This is the Strategic Petroleum Reserve
that was created in the early 70s to combat the political issues that developed from the Yemenis war when Saudi took the other position and cut off oil to the U.S. and created an energy crisis. Well, he said, I got midterms in the fall. I got to get the price down. And he started aggressively taking that inventory down. And it amounted to 500 to 600,000 barrels a day. And so those two things brought it down. But those are all just little bandages on a huge wound. And you don't take the volume, you don't celebrate that the price is down without recognizing you've made yourself, from a security perspective, very vulnerable. And I think a lot of people are very worried that that SPR is too low now. It's almost empty, pretty much. He's now sucking sour barrels out of it even. That's how low they're getting.
What do you mean, sour barrels?
Sour barrels are heavier, so they sit lower in the storage.
Oh.
And those sour barrels would have been the Iranian barrels put in back in 84, actually, because they just sit there. Because the whole thing sits with barrels in the storage that never go away.
Yeah.
There's a certain amount of the storage that never gets used. It's needed for the pressure to maintain itself. If you pull them out and you pull all the pressure out of that storage, you lose the usage of that storage forever. So that oil, it looks like there's a bunch left, but that oil has to stay there. It never comes out. So it will take them at the full pace, if they want to fully start injecting oil back into the storage again, It'll take them 1.8 years at full capacity injections today. So this country is sitting at a very precarious, vulnerable geopolitical situation without energy. I mean, he's making idle threats to Japan or to China about Taiwan, and he doesn't even have the energy to use to fight the battle, right? That's the kind of thing that's developed. The world is developing a much higher risk environment and higher cost environment. Higher risk by reducing the SPR, higher risk by suddenly, because of the awkwardness of the price of power, they're willing to negotiate with Maduro in Venezuela now, and they're willing to negotiate with Iran. They would not have done that if they had cheap power. Mm-hmm. So you're willing to forego geopolitical risk for your power prices and political health. And that, to me, is an alarm bell going off. And it's a geopolitical value that is not built into the price yet. So all the ducks are lining up for us in all areas: geopolitical, energy security, supply, demand. OPEC's in control to the extent they can. They cut 2 million barrels back recently, and everybody accused them of trying to derail the economy. And they're doing the opposite of that. They're trying to stabilize the oil price, because an oil producer can't go out and just produce. You asked me earlier, why aren't they just producing with all this cash? And I told you that the services aren't available, and they have headwinds from the energy investment community. Well, the oil price is backwardated too. It's the price today is higher than the price is a year from now in the futures. So why would they drill today, and by the time they get their oil in the market, it's actually at a lower price than it is today? You need the price to stabilize, and then they can see out, and they'll do that. You also don't increase your production when everybody's threatening you to tax you. I'm an economist, and in every model you tax, you take away product, and your costs go higher. How do you get your costs down, and how do you get your products up? By incentivizing an industry. And they're doing the exact opposite right now. So the producers are not going to spend, and they won't turn around on a dime and do it either. It'll take 5 years to get this thing turned around when it gets the positive signal to do it.
Every time I hear you talk, I get sweaty palms. It is worrying. And I guess one of the things that comes out of it is we had that brief moment in May of 2020 when the price of oil went negative. And, for a day and a half, everyone was sort of like, oh my gosh, the price of like no one wants oil. And then you start going into it and you find out about, more about the commodities market. You find out more about how people try and trade the spot price. You find out there's a whole bunch of paper no one ever intended to collect on. And you realize so little about one of the fundamental pillars of the society.
I've tried to think about how to attack that with people, and I think, without getting too complex about it, I think the way to understand how we approached it, because that was in March of 2020. It went negative that day, and I was on Bloomberg TV that day talking to Amanda, and she was all, "Oh, you must be worried," and I'm like, "No, no. This is all paper barrels, derivatives trading it. There's a lot of people talking about the terminal value of oil, and all of the pundits it was like the piece de resistance of the energy climate movement. They were all saying, we win." Yeah. And I'm watching the physical market going, no, you lose. Like, this is a disaster, because the developing world, which is the majority of the population, are going to start running faster and use more. And we did not show up with the alternatives.
Yeah.
The $3 trillion we spent came back with nothing but just a little movement in the experiments, and that's it. And you saw it in what happened with Texas. You saw it in California. You see it now in Europe. And so we believed at that time, and I said it to her right on the TV. I said, I actually think there are several hundred, even 1,000% return ahead of these things. And they all lifted off that bottom. And now one of your questions might be, well, has it gone too far, too fast? Did we miss it? Those things traded at a valuation they've never traded at in their history. So they came off of a zero value, heavily debt laden. Now they're sitting at a value that is commiserate with the historic bottoms we've had in the cycle before. No debt associated with them, free cash flow, structured like conservative manufacturing businesses. And the market is just starting to realize that as they become invested in it. And that 13% equivalent yield of dividends and buybacks, we think are going to get chased down, that yield, and that's going to expand the multiples. And we see almost 3 times the value they're trading at today, which is insane for me to say that as a fiduciary. But that's literally what the numbers are giving us relative to the rest of the market.
It's very bullish.
So, your hands get sweaty, you say, and so another client of ours yesterday, I was in Montreal yesterday, and they said, oh, I don't know whether to be happy or sad. And I get it. It's a sad story. But remember, I'm not here to talk about it from a political perspective. Politics are affecting the industry. We're monitoring what it's doing and trying to figure out how to make money off that. It's an investment strategy. It's not a call on politics or it's not a call on the importance of climate change or not. This is about power prices. Your costs are going up. That's another fact that's happening, especially in the developed world, because we are beholden to the developing world for the power, and they're going to make it very expensive for us.
So I guess one of the things that, and I think it's very reasonable, when I bring up your investment, your fund, or any other energy fund right now, a lot of average investors will look at that and they say, well, I don't want to be part of the world that was. I want to be part of the world that is tomorrow. And in their minds, as you say, they've heard from the media, they hear from their politicians, the direction that we're going in is going to be green. It will be solar, it will be wind, it might be nuclear, possibly hydro, but I think all the good hydro is already been tapped at this point. And I think that, there's already so many things that I think about my car, which is a hybrid. My car probably has 30,000 components to it. Each one of those components, part of a supply chain, each part of that supply chain requiring energy inputs to make it happen and come together. When you say you've got about 15% exposure to the alternative space where you're looking at some things that you like, what is wrong with the alternatives that we have been experimenting? Why is it not solar? Why is it not wind? Why can they not become part of that supply chain? Why can they not disrupt that?
They don't have the heat content, first of all. It's all low gauge. And you can't find, it's usually wherever the wind is blowing, you don't usually have high concentration of houses. You don't build where it's windy. So where it's windy, you got to get that power to the high concentration power usage areas, and there's an incredible loss there. And
is that what? And sorry, what does low gauge mean? You said it's all
low gauge power. It's just low generation power. So it'll help with you want your electric cars. If everybody wants to put an electric car today out there, it would take trillions of dollars just to rebuild the infrastructure to handle it, because we don't even have the infrastructure to handle all the electric cars that people want. On top of that, we can't power them with these silly power sources that are called renewable when they're just alternatives. They also have enormous environmental impact, negative. And so that electric car is being powered by natural gas. Right? And all the different hydrocarbon power sources still that we're using. So the more electric cars we use, the more gas we need to run them. And we need to keep spending massive money to build out the infrastructure and change the infrastructure that we had, because these things have such a huge demand for power that they use. So it's not even making sense. I'm a logical, practical, pragmatic thinker. And that thing looks like you're trying to shove a square through a circle right now. It doesn't work yet. It all takes time. And even then, on the other end of it, it'll likely be an electric car being powered for the most part by natural gas. And we just got to worry about the emissions of the gas that we are producing to create the electricity to run that vehicle. I'll give you another example too. That electric car, all the stats on its life and the battery is based on an environment that is much more friendly, sunny, and hot than where Canada is. Those cars are just inherently 15 to 20% less effective up here. So there's a whole part of the world that these things don't work for. It doesn't make sense, but we're going to shove them in the system anyway for a period of time. So when you're having to incent people to buy them by giving them rebates, and I tell you about how they get charged and powered and the logic about that, you start to go, these things were experiments that people are taking too much risk with their money right now. You add on top of that all of those neat ideas like Plug Power or Canadian Solar or Ballard Renewable. All of those things are kind of like, Brookfield Renewable. All of those things got valued aggressively because of the growth future expectations, not what they're actually pumping out. They weren't creating any profit. And then we started to pump money into that system. And we said, through fear and guilt, we told people to give these alternative strategies money. And what we found now is the fiduciaries took that money and just kept piling into those same experiments, ramping up the values of them. Well, now fast forward today, they're all off 70 to 80% in value. So you've lost 80% of your value of your investment in it. And the alternative did not show up. And what's even worse, and this is the behavioral part, is the developed world who gave all that money, we've seen their demand for oil go up since. So we think they thought, oh, we're going to get an alternative by this investment. And the alternative didn't show up, but they thought there was. So they kept using their oil and in fact started using more. So now we're spiraling out of control on our demand for oil and no alternative. And we attack the supply, which will take a decade to turn around and bring it into the system. So we are going into a higher cost environment, whether we like it or not. We can't get away from it. And the only way to directly offset that we can see is owning the group like this. And lo and behold, Canada's in the best situation in the world today because we sell our commodities in US dollars. And while our dollar's not at par, we're making about a 20 to 23% premium on that barrel versus our US competitor right now, all because of the currency exchange.
That's okay. So
sweaty palms.
Sweaty palms. Sweaty palm. I guess there's an element here where I want to ask you now about national interest, but again, you're not a politician, and so I think it's unfair to burden you with that. But I am curious, I guess, if you speak to someone, what are you saying to them when you're describing yourself as a pragmatic person? You're logically thinking about the realities here. The realities are we have huge energy input needs, and that those needs are, as you're saying, cannot be met by existing green alternatives. And so I think I've heard you speak many times. So this is not the first time that I've heard some of the things that you're saying. So I'm going to jump to one of the places you say is that we are greenwash some of our previous energy things into being green. So liquid natural gas, nuclear power, could even be hydrogen at this point, but I understand that might even be more polluting than lignite. So it doesn't really matter. The point is that we are looking.
They couldn't even get to them. You can't get the hydrogen to the market for another 5 years.
Yeah.
And there's all these time delay and risk to it. Plus, I've yet to see any of these projects built, shown to me without any cost overruns. So every other project in the world that's being built on any other type of agenda is all in these 50 to 100% cost overruns and time delays that are 50 to 100% time delays. And yet these things are all going to get built on time and on budget. So there's just a lot of risk to those things right now, on top of the fact that they're experiments still.
Yeah.
Yeah. So they just don't, we still are addicted to oil and gas. And you said it, I'm a pragmatic person. I'm trying to find out if alternative energy is a bias or it's part of the solution. It's still a bias. It will one day, some of it become a part of the solution, but until it is, from an investment perspective, if it's a bias, it's a risk. And I'm thinking about where the safest place to put your dollar is with the best return. It's not there right now.
Okay. Devil's advocate, though.
Yep.
You're me, and you've got your family in Spain in the summer, and every day the temperature was above 42 degrees for your visit. London has a 40-degree heat wave. Never in recorded history have they had that. We had heat waves at all parts of almost all the way across the planet. I think it was one of the hottest years on record, with more, record-breaking temperatures than we've ever had before. Someone looking at that hears what you're saying, and they just think, you're on the wrong track here. Like all this does is tell me that we need to redouble our efforts into green energy. Why is it that we should be?
Sure.
Why should we not be throwing our money? Why should we be putting any money towards this?
We should be putting all of the money into cleaning up the emissions of the oil and the gas, instead of putting our clients' money into these silly experiments. These experiments should be done by private equity and very high risk capital, trying to figure out the solutions, not our clients' pension capital. That is ridiculous. So yes, fight that fight, but with the right capital. Your capital should not be in it. It's not appropriate. 100%. We can continue to try to make the emissions better of oil and gas, which is where it's actually going now. And we should also be being more mindful about recycling the water we use, which we're doing more of now. We should be trying to figure out how to make those wind and solar facilities more efficient than the 1.8% of power they contribute right now, and the ugly sprawl that they create. All of those things need technology, but that money should not be pension money or my fund's money. That should be stuff no different than any other technology that got developed in any other field with high risk angel investors 100% of the time. But politicians have tried to separate you from the cost that you're going to incur, and on top of that, the risk you're going to take with those silly experiments. So you're going to get more costs. It's going to get more expensive to live here, and it's going to get expensive here, really ugly. And on top of that, they're making you direct your money into these silly experiments. That's like a complete catastrophic situation financially. So the costs are coming whether you like it or not. Why not invest instead in the thing that's directly associated with that, which is the hydrocarbons? It's not the client's job to have to fix the problem. They should leave it to the capital system, and they should leave it to the risk takers. And the way the risk takers would do it is by the governments creating incentive for them to do it. How did we develop this meager basin in North America and Canada that we have, this oil industry now? 40 years ago, 50 years ago, we created incentive. Otherwise, there was no one that was going to drill it. So they created tax pools, exploration and development tax pools. They gave the oil sands direct write-offs against building their facilities to the royalties they spent. And we built out an industry from basically 400,000 barrels a day then to equivalent of 9 million barrels equivalent in gas and oil today, all through incentives. All those incentives are gone now, and that industry is mature. And as I mentioned, it's manufacturing. And the good news to Canada is after all that time, taking those risks and putting that to work, that money, and creating jobs in Alberta, having a lot of success for Alberta that created huge transfer payments to the rest of the country, it is time for that basin to give back. And I'm not predicting that. It's happening now. I've mentioned this before, but historically, the royalties that the oil sands have paid since 1990 is $3.5 billion on average. This year, they're going to pay $21 billion and $27 billion on strip next year. Then, I mean, income taxes for the federal government. There's no more tax pools. All these companies are making real income and they're showering the government with tax dollars. Canadian Natural paid royalties and income tax average of $1.5 billion since it's in the last 20 years. They're going to pay $11.5 billion this year. So Canadians are rich. That's why the dollar actually will move to par, because of the oil industry.
Okay. There's a lot to process in that. So I was going to say to you, because ultimately when I look at your funds, we are talking about Canada, right? So we've got this global story, but ultimately when we get down to brass tacks, where the money goes, it's where I look for you.
We are very focused in Canada today. The funds have been as much as 70% outside of Canada.
Okay.
I mean, when we were invested in the early stages of the LNG market, that was all US.
Okay.
Global. We've invested in the US gas producers. We've invested in the US oil producers and the oil services, the pumpers down there too. Today, you would be very focused on Canada right now. A handful of our income fund names, a higher percentage is exposed into the US for larger liquid yielding businesses. And historically, we would normally not recommend the income fund at the bottom of the cycle. When you're really constructive, you'd invest in the energy fund. But because of this unique new model that these producers are, that they're distributors now, historically, the distribution model of income in energy in Canada was the pipelines and infrastructure companies. And they're all pumping out about $10 billion a year in income and buybacks of their stocks. This year, the group is giving $45 billion. So 30 billion of it, 32 billion of it is the producers now. And they're pumping out a huge percentage yield higher than those yielding pipes. So the market's either wrong and that yield needs to come down, or I'm wrong and that yield's going to go away because the cash is going to disappear. I can't find a way for the cash to disappear. So as the market matures and watches these companies over time keep giving back money, they're going to chase that yield down. And that income fund might be the best risk reward business you can own today.
So as a Canadian, you're looking out over the near future then, and we'll wrap up after this because I appreciate all the time you've given us today, Rafi. But there is obviously, I mean, in the last decade, I mean, it took forever for us to not build a pipeline. I think the Americans built 10 pipelines the size of Keystone in the time that they debated whether this one pipeline should go on. I remember I was at a lunch with your former mayor of Calgary, and he was, he was making a good case about, it's like, why is this one pipeline become such a hot topic? Like, it's one pipeline, but we've shut that down. Right. We've had a difficult time building pipelines across the country. Quebec is quite happy to take oil from Alberta, but it's quite unhappy to let oil from Alberta go across Quebec to any kind of shipping. It feels like Canada, Canadians may be rich, but it's very much at loggerheads with how they would like to be rich. So, what are when you?
We're going to get richer.
We're going to get rich.
The pipeline. So the pipeline south, the Keystone, was the least of our choices. We would have rather have one to the West Coast or the East Coast.
Yeah,
we got the one to the West Coast. It's going to be built in 18 months, and what that does is it takes us for the first time from having one buyer of our oil, which is the Gulf of Mexico.
Yeah.
Now we get to bid against two parties, the Far East and the Gulf,
Yeah.
which means we get to negotiate the rate. We're not a price taker anymore. So you know how WCS trades at a discount to WTI, Western Canadian Select, we call it, the Canadian oil, the heavy oil, trades at a discount to the WTI. It's arguable it could trade at a premium after that, because that we will capture the what we call the crack spread, or the margin that these refiners are grabbing when the prices get skewy and we have only one buyer. We all pile in, sell our oil, and they buy it all from us and wait for us to be a taker, bid it down. We all give it to them cheap. Now we're going to negotiate. So I think Canada is going to benefit greatly from that.
And who becomes our buyer in that situation? Because right now, Canadian oil, as you say, it goes down to the Gulf Coast. That means that Canadian oil is never used in Japan. It's never used in Taiwan.
It'll get used there now.
Yeah.
But remember, we produce a heavy oil, as does Venezuela, as does Mexico and Colombia. Colombia has gone from 1 million to 750. Venezuela's in disarray. And Mexico last year announced that at the end of last year, they were going to cut their exports by 50%. And at the end of this year, they're going to zero, because they are a net importer of oil now. So they don't want their oil going out. Yeah. So the refiners have lost all that heavy. Their only heavy left is ours. And on top of that, the Far East needs it too. So we are starting to elevate our opportunity dramatically. Our Monday energy note last week, we did a 2-pager on that energy note instead. And your clients might enjoy reading that one as well. It's a pretty strong dissertation around the opportunity that is developed in Canada. Actually, BNN Bloomberg wrote a summary of it as well, explaining that we believe Canada has positioned itself, because of the product, in the developed world with security risk. In spite of our government, the global developed world is going to be calling on us for our oil, because it is a matter of security now, and we will have to develop it. So we see a very prolific period. There will be expansion. It will probably have to come with the likes of a new government to change the policy, because this government is now very, rigid about their policy, and it doesn't favor this. But the global demand for our oil will almost force that to happen because of security risk.
Rafi, it has been an hour, and I really appreciate your time. And I take it you are contacting us you're in Calgary, right? You're not in.
Yeah, I flew back in today. I was in Ottawa and Montreal the last 3 days, full houses. It was a really enjoyable. It was fun actually to be in Quebec, where they're struggling with the message of energy. And now everybody's, the commonality there was 2 things. One, the costs are going up. And the second thing seems to be this belief that when the war ends, everything's going to go back to normal, whatever it was pre-COVID, and Russia's going to be allowed to start producing and distributing to everybody again. We ought to get our heads out of that thought. The world's splitting up into 2 parts. And on an energy perspective, we are much weaker. And Russia will be very much focused on that other side.
Well, I suspect I could probably talk to you for another hour without you repeating yourself at any point in the next 60 minutes. But I think this is probably far enough. And I do want to thank you again for your time today.
My pleasure.
We'll put this up on YouTube so everyone else can see it. Michael, I'm going to bother you for the 2-page summary, and we'll attach that to this. And Rafi, thank you very much for making some time for me today. And I very much enjoyed your dissertation.
If your clients have any feedback or comments or thoughts, our group, they can send them to Mike, and we will get back to you guys with some form of a response, either opinion or facts that they need to support stuff. We went through a lot of stuff there, and at a very high level. So we're there to do it for sure.
Well, thank you very much.
Okay.
Thank you everyone for watching. This was the Walker Report. Thank you, Kyle.
Yeah, Andrew.